Listen to me very carefully. What happened at exactly 9:45 a.m. Eastern Time this morning was not a market correction. It was not profit-taking. It was not even a flash crash. I'm watching something on these screens right now that I have never seen in 32 years of trading. Silver was supposed to obliterate $100 today. Asia drove it to $98.40 in overnight trading. The momentum was unstoppable until 9:45 a.m. hit. And then someone pulled a trigger. $2.7 billion in sell orders in 90 seconds. But here's what they don't want you to know. Those sell orders didn't come from panic sellers. They came from, welcome, my friends. Welcome to Currency Archive. You know, I've been doing this long enough to remember when market information wasn't available at your fingertips. And if you're watching this, if you found this video, you're the kind of person who remembers when a handshake meant something, when institutions had honor. Do me a favor, would you? Hit that subscribe button down below. Not for me, but because what I'm about to show you in the next few minutes needs to reach every person who still believes the financial system plays by the rules. And leave a comment. Tell me where you're watching from. New York, London, Mumbai, small town America. Because what happened at 9:45 a.m. this morning, it affects all of us. Now, let me show you the crime scene. On Monday morning, March 3rd, 2026, traders across Asia watched their screens with growing urgency. Silver prices were climbing fast. The reason was simple. Operation Epic Fury had turned shipping lanes into war zones. Oil tankers were rerouting thousands of miles to avoid conflict. And insurance costs on cargo ships had exploded by 400% overnight. History had taught these traders a clear lesson. When geopolitical chaos erupts, when supply chains break, when uncertainty spreads, investors run to precious metals. They had seen it in 1973 during the oil embargo, in 1979 during the Iranian Revolution, in 2003 when Iraq burned, in 2011 during the Arab Spring, and in 2020 when the pandemic locked down the world. Every single time, silver soared. And this time felt different, bigger, more dangerous. The Asian markets opened first, 8 hours ahead of New York, and the buying began immediately. In Shanghai, traders were placing orders before dawn, pushing prices higher with every transaction. In Hong Kong, wealth managers were calling private vault operators at 2 a.m, desperate to secure physical silver for their clients before the Western world woke up. The price had closed Friday at $93.66 per ounce. By Monday morning in Asia, it had rocketed to $98.40, just $1.60 from the psychological barrier that everyone was watching, $100 per ounce. Analysts were making calculations, checking historical data, running probability models, and every calculation pointed to the same conclusion. Silver should break $100 within hours, possibly reaching $112 by the end of the trading day. The momentum was unstoppable. The fundamentals were concrete. The fear was real. Then, 9:45 a.m. Eastern Time arrived, and something happened that defied every rule of supply and demand. In exactly 90 seconds, $2.7 billion worth of sell orders flooded the COMEX exchange in New York. Not gradually, not over minutes or hours, but in one concentrated blast of selling pressure that hit the market like a sledgehammer. The price didn't just pause, it reversed violently. From $98.40, silver crashed down to $97.83, a move that erased all the Asian gains, that stopped the $100 breakthrough dead in its tracks, that left thousands of traders staring at their screens in disbelief. But here was the problem. The sell orders didn't come from panicked investors. They didn't come from profit takers cashing out. They didn't come from retail traders hitting their stop losses. The volume was too large, the timing too precise, the execution too coordinated. Someone with enormous resources had waited until exactly 9:45 a.m., 15 minutes after the New York market opened, and unleashed a calculated attack on silver's price. Experienced traders began analyzing the order books, looking at the data forensically. What they found was disturbing. The selling had compressed into a 90-second window, an impossibly tight time frame for natural market behavior. The order book depth, the layers of buy orders that normally cushion price movements, had mysteriously disappeared just before the sell wave hit, and the selling continued in patterns that looked algorithmic, computer-generated, institutional. This was not a market. This was an intervention. Somewhere in the world, physical silver was being bought by the ton. Solar panel manufacturers needed it. Electronics companies stockpiled it. Wealthy families wanted it in their vaults. But on the screens in New York, the price was falling. The gap between reality and the numbers on the screen had become a canyon. And the most troubling question remained unanswered. Who had the capability to move $2.7 billion in 90 seconds? Who had the motivation to stop silver at $98 when every economic signal screamed for it to reach $112? And why did the regulators, the media, the compliance departments remain completely silent, as if nothing unusual had happened at all? The answer to these questions would reveal something far more dangerous than a single day's price manipulation. It would expose the entire architecture of a system designed to control, to suppress, and to lie. Most people believe that when they buy silver, they own silver. This is not true. What they actually own, in most cases, is a promise, a digital contract, a paper certificate, a legal obligation from an institution that claims to have silver somewhere in a vault. And this distinction between physical metal and paper promises is where the entire deception begins. The COMEX exchange in New York, the primary marketplace for silver trading in the Western world, operates on a system that would seem absurd if explained to someone unfamiliar with modern finance. For every 100 ounces of actual physical silver sitting in COMEX vaults, the exchange allows trading of contracts representing 500 ounces, sometimes more. This is called leverage. Banks and trading firms argue this creates liquidity, that it allows farmers and manufacturers to hedge their risks, that it makes markets efficient. But it also creates something else, the ability to manipulate prices without ever touching real metal. On that Monday morning at 9:45 a.m., someone didn't need to sell physical silver. They simply needed to flood the market with sell contracts. Digital promises to deliver silver at a future date. Contracts that could be created with a few keystrokes and enormous capital backing. The mechanics work like this. A major bullion bank, one of perhaps 8 institutions with special trading privileges on COMEX, can sell futures contracts far exceeding any physical silver they actually possess. These contracts move prices immediately because the market treats them as equivalent to real metal, even though they are just paper. When thousands of these contracts hit the market simultaneously, the price drops, regardless of what is happening in the physical world. This is not theory. This is documented fact. In 2020, JP Morgan Chase paid $920 million to settle charges of precious metals market manipulation. The bank admitted that its traders had used techniques called spoofing and layering, placing fake orders to deceive other market participants, creating false impressions of supply and demand. But here is what most people missed. The settlement was for past behavior, the fines were paid, and the same institutions retained their trading privileges. Nothing structurally changed. The same banks that were caught manipulating markets still had the same access, the same tools, the same incentive to control prices, and they had learned to be more sophisticated. At 9:45 a.m., the selling pattern showed all the hallmarks of algorithmic execution. High-frequency trading computers, located in facilities called co-location centers, just feet away from the exchange's matching engines, can execute thousands of trades per second. These computers have advantages measured in microseconds, millionths of a second, that allow them to see incoming orders and react before human traders even know what happened. A retail investor in California clicking buy on their brokerage app, and a high-frequency algorithm in New Jersey front-running that order. The difference in execution time, 14 milliseconds. In that invisible gap, fortunes shift. But speed is only part of the advantage. These institutional players also have access to order types that retail investors have never heard of. Iceberg orders that hide true volume, fill or kill instructions that prevent price discovery, midpoint peg orders that game the spread. The playing field is not level. It is not even visible to most participants. Now add another layer. Exchange-traded funds, the popular silver ETFs that millions of investors buy, thinking they own metal. These funds hold physical silver, but they also have a redemption mechanism that allows authorized participants, a small group of major banks, to create or destroy shares. When silver prices rise too fast, these banks can create new ETF shares, flooding the market with paper supply, suppressing the price without mining a single ounce. The beautiful trap is complete. Physical silver takes months to mine, weeks to refine, days to transport. But paper silver, contracts, ETF shares, derivatives, can be created instantly, in infinite quantities, by institutions with enough capital and exchange access. And there is one more critical detail. The number 100. Round numbers in financial markets are not just psychological. They are structural trigger points. At $100, Thousands of derivative contracts had strike prices, options that would suddenly be in the money, margin requirements that would spike, automated trading systems programmed to react. If silver broke 100 and held, it could trigger a cascade, hedge funds covering short positions, retail investors piling in, industrial buyers panicking about costs, a self-reinforcing surge that could push silver to 150, 200 levels that would expose just how naked the emperor truly was. So someone stopped it, not with supply and demand, but with algorithmic force, concentrated capital, and a market structure designed to allow it. The question was never whether manipulation was possible. The question was whether anyone with power cared enough to stop it. When a price is artificially held down, the market does not simply accept it and move on. Instead, something far more dangerous happens. Reality splits into two worlds. In one world, the world of computer screens and financial news tickers, silver trades at $97.83. In the other world, the world of factories and vaults and shipping containers, silver becomes impossible to find at that price. This divergence, this crack in the foundation of price discovery, creates consequences that ripple far beyond the precious metals market. Walk into a coin shop in Texas on that Monday afternoon. The owner glances at his computer screen, sees silver at $97.83, then quotes a customer $108 for a physical 1-ounce coin, $10 above the supposed market price. The customer asks why, and the owner gives a simple answer. Because I cannot replace this coin at $97, no one will sell to me at that price. The price you see on that screen is fiction. This is called a premium, and in normal markets it runs 2 to 4% above spot price. But on this Monday, premiums in North America were hitting 11%. In some European cities, 15%. In parts of Asia, 17%. The paper price said one thing, but the real world demanded another. Now multiply this distortion across the global economy. Solar panel manufacturers, who use silver in photovoltaic cells, suddenly faced a crisis. Their procurement teams were calling suppliers, trying to lock in physical silver at forward contracts, and discovering that sellers wanted prices far above the COMEX quote. The spreadsheets that calculated production costs, the budgets approved by boards of directors, the price projections given to investors, all suddenly obsolete. Electric vehicle companies, semiconductor fabricators, medical device manufacturers, everyone who depended on industrial silver faced the same nightmare. The price they saw published was not the price they could actually pay. Some companies began stockpiling, buying 6 months of supply instead of 2, hoarding metal while it was still available, which of course made the physical shortage worse. In Shanghai, a completely different price structure was emerging. Chinese buyers were paying the equivalent of $102 per ounce, $4 above New York's paper price, and still struggling to secure large quantities. The Chinese government, which had been accumulating precious metals for years, watched this divergence with great interest, because it revealed something strategic. The Western financial system's control over commodity pricing was breaking down. For decades, New York and London set global prices. COMEX and the London Bullion Market Association were the reference points. What they said was gospel. But when their prices became obviously disconnected from physical reality, their authority evaporated. A new question emerged in Beijing's planning committees. What happens when Asia simply stops pretending that Western paper prices matter? What happens when the largest manufacturing economy in the world starts pricing silver based on actual supply and demand, not on derivative contracts in New York? The answer was forming in real time. A bifurcated market, where paper silver and physical silver become completely separate assets, trading at completely different prices. Back in the United States, another consequence was unfolding quietly. Pension funds, university endowments, insurance companies had allocated small percentages of their portfolios to precious metals, seeking diversification and inflation protection. But most held silver through ETFs and futures contracts, not physical metal. On Monday, their statements showed silver positions valued at $97.83. But if they tried to convert those paper positions into actual metal, they would discover the real cost was $108, $112, whatever the physical market demanded. The difference was a hidden loss, a phantom liability, that would only become visible when they tried to exit. Thousands of financial advisors had told clients that precious metals were a safe haven, a store of value, a hedge against chaos. But what good is a hedge when the price is fake? When the asset you think you own cannot be obtained at the price you think it costs? The trust damage went deeper than dollars and cents. Every investor watching silver that Monday, seeing the Asian surge, seeing the war headlines, seeing the supply chain collapse, and then seeing the price mysteriously drop at 9:45 a.m. They learned a lesson, not about silver, but about the system itself. They learned that markets are not free, that prices are not honest, that the institutions claiming to provide fair dealing are willing to intervene whenever outcomes become inconvenient. And once that trust breaks, once people realize the game is rigged, they start making different decisions. They pull money out of paper markets. They buy physical assets they can hold. They diversify into cryptocurrencies and real estate and foreign currencies. They stop believing, and an economy built on confidence, on the belief that tomorrow will function like today, begins to experience the business leader sitting in a Chicago boardroom, the young entrepreneur building a startup in Mumbai, the investor reviewing portfolios in Sao Paulo. They all face the same question now. What do you do when the markets lie? This is not a theoretical exercise, not an academic debate about efficient market hypothesis. This is an operational problem with immediate consequences. For the manufacturing executive, the one whose company needs silver for circuit boards or medical equipment or solar installations, the 9:45 a.m. manipulation created a procurement crisis that requires immediate tactical response. Relying on COMEX futures to hedge input costs, the traditional risk management strategy, has become unreliable when futures prices diverge from physical availability. The solution emerging among sophisticated industrial buyers, direct relationships with mining companies, long-term physical supply contracts, strategic inventory reserves that buffer against both price spikes and supply interruptions. Yes, this ties up capital. Yes, it reduces reported efficiency metrics. But efficiency means nothing when your production line stops, because you cannot source materials at any price. The financial textbooks call this just-in-time inventory management. The new reality calls it just-in-time bankruptcy. Smart operators are shifting to just-in-case inventory strategies, accepting higher carrying costs as insurance against a system that no longer functions predictably. For the entrepreneur, particularly the young founder building a business in 2026, the silver manipulation teaches a deeper lesson. Every system has hidden fragility. Every market has unseen manipulation. Every price has potential distortion. The competitive advantage goes to those who plan for institutional dishonesty, not those who assume good faith. This means stress testing business models against scenarios where suppliers lie, where regulators fail, where market prices become divorced from reality. The entrepreneur in Bangladesh launching an electronics assembly operation. She cannot simply check silver prices online and build a budget. She must verify physical availability, establish backup suppliers across multiple countries, maintain cash reserves for sudden cost spikes. She must operate as if the financial infrastructure is adversarial, because increasingly it is. This is not pessimism. This is realism. The businesses that survive the next decade will be those led by people who understand that stability is an illusion, that published prices are suggestions, that contracts are only as good as the counterparty's solvency. For the individual investor, the person trying to preserve wealth across years or decades, the strategic response requires fundamental rethinking. Holding silver through an ETF seemed safe, seemed liquid, seemed smart, until the moment when paper price and physical price separated by 10%, 15%, 20%. The investor who wants actual protection, not just paper exposure, must solve the custody problem. Where do you store physical metal? How do you verify its authenticity? How do you insure it? How do you eventually sell it without getting destroyed on spreads and premiums? These are not simple questions, but they are necessary questions, because the alternative is discovering during a crisis that your hedge was imaginary. Some are turning to blockchain-verified precious metals platforms, systems where physical metal sits in audited vaults while ownership transfers via digital tokens. Others are using allocated storage with third-party verification, paying fees for the certainty that specific bars with specific serial numbers belong to them. Still others are simply buying coins and small bars, accepting the higher premiums as the cost of true ownership, storing them in home safes or bank deposit boxes. Each solution has trade-offs, but all share one characteristic. They treat the financial system as untrustworthy until proven otherwise. Now zoom out to the macro level. What the 9:45 a.m. silver manipulation revealed, what every similar intervention reveals, is that price discovery in critical commodity markets has been compromised. And when price discovery breaks, when market signals become noise, when participants lose faith in the fairness of the system, capital flows change direction. Money that would have stayed in Western financial markets, in dollar-denominated assets, and securities priced on New York exchanges. That money begins exploring alternatives, the Chinese yuan, gold-backed digital currencies, cryptocurrency networks, European green bonds, emerging market equities. Not because these alternatives are perfect, but because diversification away from a corrupted system becomes rational risk management. The people who manipulated silver thought they were defending the dollar's credibility. They were actually undermining it. Every intervention, every obvious manipulation, every moment when the price clearly contradicts reality, it teaches global capital that the system cannot be trusted. And once that lesson is learned, it cannot be unlearned. The strategic guidance for the next 24 months is clear. Prepare for bifurcation, the splitting of paper markets from physical reality. Prepare for volatility, the wild swings that happen when manipulation eventually fails. Prepare for dislocation, the moments when prices gap, when markets freeze, when the smoothly functioning system reveals its fragility. Most importantly, prepare psychologically. The institutions that have governed global finance for 70 years, the banks, the exchanges, the regulatory agencies, the central banks, they are not going to voluntarily relinquish control. They will intervene again. They will manipulate again. They will claim it is for stability, for liquidity, for the good of the markets. And each time they do, the gap between their narrative and observable reality will widen. The question is not whether the system will break. The question is whether you will be positioned to survive when it does. The 9:45 a.m. silver heist was not an isolated incident. It was a warning, a glimpse of how power operates when threatened, a preview of the tactics that will be deployed as the old order fights to maintain control. Those who understand this, who plan accordingly, who build resilience into their businesses and portfolios and strategies, they will navigate the coming turbulence. Those who continue trusting that markets are fair, that regulators protect investors, that published prices reflect reality, they will learn these lessons the hard way. The choice, as always, belongs to the individual. But the clock is ticking.